Good morning to all attendees around the globe. I would like to welcome you all to our webinar titled Capital Flows in Latin America Meet the Current Global Economic Landscape. We are honored to have keynote speakers today who represent three areas in Latin America and who are experts on capital flows in Latin America. Perhaps there's not a better timing to hear their insights and outlook for the stability in the region in terms of macroeconomics, the evolution and insights in terms of capital flows in a context that is marked by high interest rates for a longer period of time than estimated, as well as marked by geoeconomic fragmentation. In this respect, the purpose of today's webinar is to analyze how capital flows have been affected by economic, financial, and political conditions both locally and globally. We shall also discuss about their performance opportunities and risks in Latin America, where external investment performance is key for sustainable economic growth. Today, our keynote speakers are experts on this subject matter. So we would like to express our gratitude to Maria Paula Figueroa, Head of Frontier Latin American Research. We would also like to welcome Martín Tobal, who is Director of Microfinancial Risk Analysis at the Central Bank of Mexico, and Martín Castellano, Head of Latin American Research. Our panelists today will provide a comprehensive outlook about the challenge that the economies in the region are facing in such a complex landscape. So each speaker will deliver a presentation, and afterwards we will open the floor for questions in order to address any concerns that the participants may have. So first, let me hand over to Martín Tobal, who is highly specialized in multilateral institutions. He has carried out different analyses on macroeconomic topics. Martín, thank you very much for accepting the invitation to deliver a presentation today. Good morning. Thank you very much, Carlos, for having me. I would also like to extend my appreciation to FLAR. Thank you for a kind introduction. I don't know whether it's a fair introduction or not, but anyways, it's been a very kind introduction. I'm Martín Tobal. I'm Director of Microfinancial Risk Analysis, as Carlos has just pointed out, and I work for the Central Bank of Mexico. Since I work for a central bank, I would like to highlight that what I'm going to share with you is not the opinion of this bank nor of its Board of Governors. This is a disclaimer. Let me now turn to this proverb that says that whenever you send a warning, you're not betraying those listening to you. So from the very first slide, I would like to warn you that I'm going to be leaving you with plenty of questions, but we will try to answer some of these questions. We will talk about the performance of capital flows, both in the medium term and in the long term. However, these slides will not enable me to give you an accurate response as to the determinant factors behind capital flows. So one of the key messages during my presentation concerning capital flows, and as the little prince used to say, what is essential is invisible to the eye. When talking about capital flows, what might look like a head at first sight, it might eventually be an elephant that has choked over eating a big snake. What I'm trying to say is that perhaps my presentation will show some ignorance. Nonetheless, I will try to sort out some issues. First off, even if I don't know the real causes underlying capital flows, those that might be considered to be circumstantial or structural ones are more important or not. So depending on this question, we will analyze what implication this has for EMEs. But most importantly, we will talk about public policy recommendations going forward. In addressing these three questions, let me conduct a two-pronged analysis. First, I'm going to provide you with a long-term analysis, and next, I will focus on a circumstantial analysis that is based on the current context. As for the long-term analysis, our starting point is what we call a golden age. The golden age lasted about 2 decades and a half. This happened just recently, began in the early 90s and finished in 2020 with a pandemic. This was an exceptional period in historical terms because during that period, global savings grew markedly, but above all, a bulk of that growth in global savings was channeled through capital flows into EMEs. During this period, there were some exceptions. Actually, these were long-term structural events that led to an increase in global savings supply. Therefore, they also led to an increase in economic growth and available income, as well as to greater income available for saving purposes. Besides, there was lower demand by AEs regarding this supply of savings, and therefore capital flows could be channeled to EMEs. So there was a quick increase in the global savings supply, and this was tied to increased growth and increased income. During those 2 decades, we could observe some global GDP rates around 3.5%. This led to commercial integration, allowing countries to specialize themselves in particular sectors or chains of the production process, and therefore increasing output as well as improving efficiency and global growth. According to the WTO, between 1995 and 2020, there was a reduction of trade costs, but this led to an increase of 6.8% in GDP. On the other hand, China, given its complementarity characteristic, was able to increase its average productivity substantially, and it also reported some significant savings. This country, therefore, represented significant surpluses on their current account. There was also a strong growth in terms of income for saving purposes during this period, and an increase of 2 percentage points over global GDP vis-a-vis the prior decade. So there was a process of greater inequality and income concentration that began in the 80s and that ended up causing people who happened to be the richest to hold even more income. As a result, the global average saving rate was also pushed up. There was financial integration. The costs of doing financial cross-border investments came down, rendering intermediation processes more effective, while also increasing average savings rates. So there was an increased global average saving rate, but at the same time, there was lower demand of savings by advanced economies, which was accounted for by lower growth of investment in those countries, as well as a lower growth in terms of the population and also technological advance. All these led to lower investments. But for the same level of investment during this period, less financing was required because even though these economies were less productive in some cases, like for example, with capital goods, production costs went down as well as the price of capital goods. Therefore, in order to make a given investment, these advanced economies required less funding, and therefore this led to lower global savings demand. So again, there was a quick increase in global savings and a lower demand by IEs in terms of savings. On the left-hand side, you can see the 10-year interest rate, and this led to some capital flow increases to emerging economies. This golden age or this grace period seems to have come to an end, but as I said before, I'm going to leave you with plenty of questions rather than answers. So after the pandemic, interest rates growth came to a halt. There was also a deceleration of capital flows to EMEs. And now savings are growing at a lower pace. This gives rise to a natural question. What are we to expect going forward? Will this halt of capital flows to EMEs, will this be permanent or an interim pause? In order to answer this question, let me continue with a short-term analysis, but let me go back to the outbreak of the pandemic. On the one hand, we might say that this is just an interim pause that is tied to circumstantial developments. But perhaps this is a more permanent kind of pause. And perhaps we are seeing a reversal in structural factors that led to savings increases during the golden age. We have some reasons underlying this argument. So today, according to some specialists, we are going through a geopolitical and commercial fragmentation process that imposes some restrictions to the circulation of goods and services that could cause the value chains to be reconfigured, and that makes it more difficult for countries to specialize in what they do particularly well, which might lead to some changes in terms of the income available. Since the pandemic, there has been an increase in geopolitical risk. Besides, this geopolitical risk leads to commercial fragmentation globally, but also from a financial stance. We could expect more financial cross-border investment restrictions, which would lead to some issues concerning intermediation and therefore discouraging savings. Another structural factor that might be affecting us is slower growth in the Chinese economy. China has begun this slowdown process since the 2010s. China is now adopting some technologies that already exist. Therefore, the IMF expects the Chinese economy to continue slowing down, shifting from 5.2% in terms of growth in 2023 to 3.3 by 2029. The third structural change that we might be seeing is the following. Advanced countries might right now be converging towards a more or a higher tax deficit. They need to invest in green technologies or more military expenses due to a more uncertain geopolitical landscape. Therefore, international organizations now believe that perhaps these economies will report more tax deficits, a greater demand of global savings, and therefore more savings available for EMEs. So the golden age that lasted between 1990 and 2020 shows the following. There was a commercial integration. China played a very important role. All this led to an increased economic growth and more income available. Then there was a financial integration and equal income that led to a greater proportion of income for saving purposes. As a result, there was a historical boom in terms of capital flows to emerging economies. The next question, therefore, is the following. All the changes that we are now seeing are really true? Are they really happening? And hence, what is going to happen going forward when we speak about capital flows to EMEs? Now, let me turn to the analysis of the current situation so that we can deep dive into this question. When we talk about the current context, we need to address some recent developments and what is happening in the United States with interest rates, or also the change of stance by the Federal Reserve as for the message they are sending. Now, let me turn to the current situation and let me share some graphs with you. These graphs, by contrast with the previous ones, are based on monthly data rather than annual data. So I'm going to talk about the current situation and I will deep dive into what has happened over the past months, not over the past weeks, and the change of the Fed's monetary policy stance. When conducting this analysis with a focus on the recent months, I will try to answer a couple of questions. I will try to answer whether this is a permanent or temporary pause. Let's see the performance of some macro financial variables. After some time in the United States, if we take into account the volatility index, rates have come down and capital flows surged. So this observation of microfinancial developments may indicate that this is a temporary pause due to the current situation. What I'm trying to say is that according to this hypothesis, during the pandemic, fiscal expenditure went up due to social and health requirements. Central banks, therefore, provided for very aggressive interest rate increases. However, after the pandemic, some structural factors prevailed, and these structural factors that, according to this first hypothesis, have not changed, and whereby the capital flow hold is only temporary, point to this fact. This reduction in terms of interest rates and inflation have exerted more pressure on premiums and on the volatility index, fostering capital flow recovery towards EMEs to pre-pandemic levels. According to this hypothesis, the levels of microfinancial variables, particularly capital flows, are now going back to previous levels. According to this hypothesis, they have not changed after the pandemic. Therefore, the performance of these microfinancial variables, according to this first hypothesis, is an endogenous response to these long-term factors. However, we cannot rush because this requires a more thorough analysis of such microfinancial variables. Actually, the opposite could also be highlighted. We could forecast the potential materialization of some structural changes that I mentioned in the previous slide. If we take a look at the same graphs more carefully, we can observe that certain political and commercial fragmentation began to arise, leading to some significant increases in the VIX rate, especially after the attacks in Israel and the attacks between Israel and Iran. However, in China, we observe that savings are growing. There is also a trend towards downward inflation and more tax deficit in the United States, or a downgrade of the U.S. credit rating. According to this second hypothesis, and by contrast with the previous hypothesis, the pause on capital flows may be deemed to be permanent. Besides, the recent behavior of these variables are also due to structural factors. But since these factors are now changing, we begin to observe certain spikes across the variables. Therefore, this chart or these hypotheses are showing that for the time being, we cannot consider these or we cannot see the structural changes from a macrofinancial perspective, but we can observe some volatility. And we know that whenever volatility goes up, as you can see here, when volatility becomes recurrent, that change in volatility eventually leads to a change. Like in the previous hypothesis, according to this hypothesis whereby the pause is considered to be permanent, the macro financial aspects are due to long-term deeper aspects. According to this hypothesis, this is actually shown by the volatility of the variables concerned. Therefore, we cannot really point out the factors that are leading to this recent performance of the different variables. In quoting the little principle, when talking about capital flows and macrofinancial variables, what is essential is invisible to the eye. When considering other measures or when conducting statistical analysis, one may also think that this pause may actually be a permanent one. Let me now show you some measures that we normally apply in order to do some calculations at the Macrofinancial Risk Analysis Office. Here we are talking about the natural value of long-term portfolios. That is to say, what is the value of capital flows as a result of changes in structural factors that are not due to circumstantial events. When calculating these measures, as you can see, with the green arrows pointing downwards, these long-term capital flows have come down, both in the case of Mexico and Brazil, but for most of the emerging economies as well, except for India, which for the time being is not showing this performance. This evidence may point to the fact that the pause on capital flows may be a permanent one. However, I wouldn't like to be too bold and affirm that this is a compelling hypothesis because statistical filters are sometimes limited. And here we are trying to talk about what is going to happen going forward. Let me go back again to the Little Princess quote, what is essentially is invisible to the eye, and we don't know, therefore, the world we are converging to, whether this is going to be a well characterized by a permanent pause or an temporary one. Now, let me be bold to provide you with some answers. Despite the fact that I don't know about the causes, I could like to make some public policy recommendations. What are the recommendations that I can make in the short term? We know that regardless of whether we are going to witness a permanent or a temporary pause, right now, we can observe some significantly high volatility levels. As a matter of fact, right now, we observe the highest VIX index volatility in the United States ever for a period of low interest rates by the Federal Reserve. So we can draw the following conclusion. Regardless of which hypothesis is right, we might consider more proper to undertake the following approach: reinforcing the macrofinancial framework and having a credible monetary policy as well as tax balance. That's our recommendation for emerging economies. We believe that that is the best way in which emerging economies can shield themselves against volatility. But now things will become more complicated when we talk about long-term public policy recommendations, because this will depend on whether the pause is a temporary or a permanent one. In that case, the world may not change considerably, but in the case of a permanent pause, eventually we might see a lower availability of savings, and therefore emerging economies may start to compete more fiercely for those capital flows. That is one of the key messages I would like to leave you with. Through that competition, other factors might have a greater weight. And here we're talking not only about macroeconomic balance or monetary policy, but also talking about the perception of the sentiment that markets might have about the risks arising from each economy. Based on the data, if we take into account emerging economies and we analyze the impact in the percentage, in the perception of geopolitical risk, considering the capital flows to that economy, you can see some results. Prior to the pandemic, a greater political risk did not affect portfolios. However, after the pandemic, that changed. If we are moving towards a new pattern or to a new global pattern, in having a solid macrofinancial framework will be crucial for the emerging economies with a good monetary policy in place and an independent central bank. Economic balance will also be required, but in addition, geopolitical risks should be low. That will be key in order to attract capital flows. Thank you very much, Carlos, for allowing me this time to share my presentation. I hope I have been on time. Thank you very much, Martin. You have finished right on time. You have provided a compelling view about capital flows to emerging economies, particularly to Latin America. You have spoken about the fact that savings have come to a halt, interest rates have climbed, and also the long-term factors that have contributed to the current performance of capital flows. As you said, many questions arise after your presentation, but most importantly, you have put forward some key elements in order to discuss whether this hold is circumstantial or structural. So this is quite a complex topic because we're talking about a mix of short-term factors, some structural factor as a result of which it's difficult to sort out which the right answer is. In my opinion, we are going through global uncertainty in political and financial terms. Therefore, against this background, having a good macroeconomic policy is essential in order to strike an appropriate macroeconomic balance in order to allure investments. You also made a good point when you refer to those phenomena that have been making investments more attractive after the pandemic in the different economies. Afterwards, we will talk further about this. For the time being, let me now turn to another expert from the private sector. Martin and Maria Paula will now share their insights with us. They have plenty of experience in the region working for the private sector as well as for central banks. Martin and Maria Paula, please, we would like to hear your opinion about what is happening with capital flows to our region, and thank you very much for having accepted the invitation to present at this webinar. Thank you very much. I would like to extend my appreciation to FLAR for having us. Today, we would like to share with you our insights about capital flows in 2025 using the IIF capital flow document published last year, which has been updated based on the information that we gather at IIF every week, and of course, based on some recent developments. I believe that you will find many similarities with the analysis that Martin has just shared with us. Carlos, I would also like to say that this global economic outlook is now being reviewed, especially after the developments that have recently taken place in the United States. So you should be very cautious in using this data. I'm going to first cover the global economic outlook, particularly for Brazil, Mexico, and Argentina. I will do that. Maria Paula, in turn, will refer to current account issues, trade, and she will talk about Colombia, Peru, among other countries. So the external context this year is going to be more hostile for the region's macroeconomic performance and capital flows. Global growth will slow down to 2.6% from 3% last year. Countries will be expanding. This deceleration is quite modest, and it shows that the U.S. economy is weaker. Also, some structural challenges coming from China, as Martin pointed out. And thirdly, a more moderate growth in the Eurozone due to low productivity and a weak domestic demand, and also the implementation of tariffs. The historical gap in favor of emerging economies against advanced economies or developed economies is now smaller, and that has an impact on capital flows to the region. There are some underlying factors for these projections. First off, we have to consider some significant political developments in the United States, and according to the the election campaign in the country and what was promised at the time. And now I would like to be clear about this. Our baseline scenario has been built taking into account that if tariffs are imposed, they will be imposed only temporarily. They will not be across the board tariffs, and they will not scale up to the point of triggering a trade war. We believe that this is an alternative scenario, but it's not the baseline scenario underlying our projections. Nonetheless, we can see now with the Trump administration that even though the proposals that have been made are quite significant and quite harsh, much more than those imposed during the first Trump administration, we believe that agreements might be expected and the commercial relationship should be more fluent as well. As Martin said, that might lead to more geopolitical risks, leading to volatility and some asset price issues in 2025. We also see Fed funds, rate paths being in line with market expectations. There are some concerns due to increased costs and also the implementation of tariffs or immigration restrictions. These are some of the essential developments that we have to watch. At the IIF, we are optimistic as to the external context opportunities for the region and for the emerging economies. We keep our opinion unaltered. We believe that there will be green investing, also the reformulation of the value chain, technological innovation, etc. All these factors will continue to play a favorable role for emerging economies and particularly for Latin America. We believe that all these forces will continue to underpin investment. On the other hand, if we now focus on tariffs broken down by industry, we believe that this could also be favorable for the region. High volatility and market sentiment might also trigger off opportunities for some countries and certain financial market segments. If we now turn to the following slide, we can see something that already occurred last year. EMs showed a high degree of resilience in attracting capital flows despite volatility, mainly due to rate cuts by the Federal Reserve. There was also a correlation in terms of FDI and developed countries. There was a gradual recovery of flows towards China due to some specific measures having been taken by the Chinese administration, incentives to technology investment, and some regulatory changes. However, the dynamics began to be favorable at the beginning of the year. This graph shows something similar to what Martin showed before. In the second half of the year, several factors came into play, and there was more geopolitical risk perceptions. Some questions arose as to the impact of inflation on U.S. policies, and the U.S. dollar increased strength. These all affected capital flows. In line with global macroeconomic outlook, we believe that non-resident flows to emerging economies will slide down this year. FDI will remain significant, and the investment in shares will slow down, showing some inequalities between regions. If we now turn to the following slide and we analyze the forecast or the outlook for the region, Latin America will not be the exception. We believe that there will be a slowdown in activity in virtually all countries. Let me mention something that I already pointed out at the prior meeting with FLAR. At the end of the day, growth in the region and the capacity to allure capital will be strongly affected by outside factors. Very often in the region, we lose sight of this fact because we encounter some social problems or fiscal issues. However, at the end of the day, we have to pay attention to what is going on overseas. This is going to be more challenging in 2025 compared to 2024, even though the region is not isolated from the rest of the world. And this can even be an asset in terms of geopolitical tensions. Nonetheless, the interrelation is quite narrow because there are changes in the current U.S. economic environment. There are different shifts in trade, remittances, and investor sentiment, all them being high. Maria Paula will afterwards talk further about this. For instance, Brazil is better insulated compared to Mexico, but nonetheless, financial conditions, globally speaking, if they become more restrictive, might exacerbate the fiscal issues that the country has with a spillover effect on foreign accounts. As you can see on the graph, we believe that GDP growth will be moderate in Mexico, Brazil, and Peru, being stronger in Colombia and Argentina. Commodity prices will also remain moderate. The market is moving in this direction, except for some cases due to geopolitical reasons. China will grow more slowly. That's another determinant factor. And there will also be more volatility in investor sentiment that will affect most economies in Latin America. But we have two pieces of good news. Taking into account this transactional environment and geopolitical changes in a fragmented world, we do not envisage an economic slump or a marked deceleration. We believe that the economic slowdown will be moderate, and along the current cycle, in general, countries will be able to keep balanced current accounts despite the fact that in some cases the foreign exchange rate may not be favorable to them. Now, the downside is that in fiscal and monetary terms, the exchange rate in most big countries in the region is an automatic stabilization component in the case of countries with high international reserves. But on the other hand, inflation rates are sometimes above the target. Some fiscal discipline issues in many countries that may cause the pass-through price to be higher than expected. We also see some funding pressure and pressure to prevent capital outflows that might lead or that might push interest rates up and which might hamper growth. According to the current consolidation plans, and given these imbalances, we can say that countries might not be in a position to use fiscal stimulus. In the next slide, you can observe that the projected non-resident capital flows will moderate in Latin America due to the same reasons we pointed out before, because there will be a cyclical slowdown in activity, also a tougher U.S. policy stance, and also terms of trade headwinds. And this will not leave much leeway for fiscal stimulus. If we take into account the data year to date, including January-related data, all these forecasts are pretty reasonable for the coming year, with FDI and private equity remaining weak, even though interest rates may be lower in line with disinflation. We believe that debt will continue to underpin capital flows. There will also be high financing requirements. Therefore, according to this slide, we believe that a year in foreign investment this year will certainly require more pragmatic monetary policies. In Mexico, we have observed that in response to some changes in the U.S. economy, they are not willing to impose tariffs right away. They're open to, well, a different stance. So in Mexico, the administration is now collaborating and implementing some specific measures, regardless of how efficient they might be. But they are going to be crucial in order to avoid the implementation of tariffs. And this is something that already happened back in 2018, 2019. In Brazil, we have to wait and see whether they will take a pragmatic approach. Nonetheless, the Brazilian central bank has used its monetary policy in order to reduce capital outflows. The next slide shows what we expect for some specific countries. In Brazil, external accounts have shown some concern about the current public finances in the country, with some current account deficits going above expectations. Therefore, we expect increased volatility in the financial market. This is not a baseline scenario or a sudden stop in terms of capital flows, but we believe that there will be more pressure on asset prices and might require higher rates than the ones currently in force. Even though Brazil has a sound external position and low US-denominated public debt, nonetheless, an improvement in public finances and an improvement in their institutional framework will be key in order to underpin investors' trust and confidence. We published a study about fiscal risks and the requirements that Brazil should meet in terms of their institutional framework in order to reduce their debt to GDP ratio. Argentina is also an interesting country. Milei has corrected most of the imbalances that he had inherited, eliminating, for example, exchange rate controls after a long period of time, but this remains a challenge for the Milei's administration. The question is whether they can wipe out these controls without leading to economic instability, even though net reserves are still growing negatively despite some recent accumulation. The main concerns in Argentina are, U.S. liquidity in order to face external shocks, and also there are some expectations as to the midterm elections. The Milei administration expects to increase the number of representatives in order to continue carrying out some of his measures. On the right-hand side, you can see the difference between Milei's administration and Macri's administration from a capital flows perspective. Financial markets in Argentina overall were characterized by a lot of funding during the Macri's administration. Right now, investors are watching whether Milei's measures will be sustainable over time or not. We believe that the elimination of controls will affect U.S. Flows, facilitating access to the Argentinian market, always, of course, in close collaboration with the IMF. More credibility might also lead to more to a better balance with the private sector playing an increasingly more important role. We have recently published a study about exchange rate pressures in Egypt and some lessons that Argentina could learn from that experience. In this higher global fragmentation context, funding costs might go up the same as commodity prices. Against this background, Argentina will have an incentive to reach a new agreement with the IMF. As for Mexico, we believe that the portfolio flows will remain in a neutral turf in Mexico up until 2015 and also until 2017. The situation was different. Right now, domestic investors are taking a much more limited stance, similarly to what happened during the pre-COVID period. We have to wait and see what happens with the portfolio, whether the same trend reported during 2022 or 2023 will occur. There are also some offshoring issues, some infrastructure bottlenecks, and some external factors characterized by political fragmentation. And all these aspects are to be priced in. These three graphs depict what I mentioned before. It's going to be difficult to slash interest rates under the current domestic and external conditions. Foreign investors' positioning in Latin America is quite low. The market is growing at higher rates. That is the case of Brazil and Chile, showing that this is quite a challenging context for the region. A non-resident portfolio investment is still rather restrained, and there are several examples in this regard. In prior years, during the golden age that Martin mentioned, Latin America had a much bigger weight on global emerging capital flows. Afterwards, we can share some additional data with you if you are keen. And in closing, yeah, you can see public finances in the region. They continue to be the Achilles heel in the region. In Argentina or in other countries, fiscal austerity was shown, and that affects the markets, eliminating private financing going to these countries and therefore having an impact on their external accounts. You can see an outline of the current public finance situation in Mexico, Brazil, and Colombia, respectively. In closing, and before I hand over to Maria Paola, I would like to underscore the performance of FDI. The last slide shows that in terms of composition and level, Latin America overall, and particularly in Mexico and Argentina, the potential to receive more and better investments is quite high, with plenty of opportunities out there. Therefore, economic policy should be consistent, sound, and sustainable, and institutional frameworks should also be strong enough in order to allow for continuity or to render these processes ongoing and in order to face all these challenges. Thank you very much. Thank you, Martin. Next, Maria Paola, you have the floor. Please go ahead. I would like to thank Carlos for allowing me this opportunity to address the floor. I would also like to thank all those attending this webinar. Thank you very much for giving me the opportunity to share with you some of our analysis and assessments about some of the current situation affecting capital flows to the region. As Martin pointed out before, I would like to focus more on the commercial side of things and the impact that the U.S. policies could have on emerging economies and on the region in particular. And finally, I would like to focus on the outlook for Colombia, Peru, and Chile, respectively. So let us start with the first slide. With the current U.S. administration, a number of measures have been taken, as a result of which the U.S. is recalibrating trade as well as immigration policies. All such measures have led to significant uncertainty with some impact on commercial partners and the global economy. Emerging markets are now highly exposed to changes in tariff policies because they are more exposed to external financing, and also because these countries depend or rely on exports for their own growth. So whatever happens in China will be particularly important for these countries. A 4.2% slowdown is expected in the Chinese economy. If the fiscal policy measures could only partially offset the outcomes of lower demand of Chinese exports, coupled with many other challenges in order to reduce the savings rate in the country, in order to promote domestic consumption, to offset the negative effect of the most aggressive trade policies that might be implemented. As for the emerging economies that rely more on exports, which are particularly specialized in commodities and manufacturing, they might be exposed to even greater risks. There are some economies that are highly integrated to value supply chains, such as Mexico, that could see increased costs affecting them when it comes to engaging in business with the United States, therefore affecting their competitiveness. The same would apply to Malaysia or similar countries. As for countries in the Andean region, the behavior of commodities will be very important. There is plenty of volatility regarding commodities right now due to some energy policies in the US and geopolitical developments going on, as well as some changes in external demand patterns. And there are also some risks coming from the Middle East due to geopolitical tensions going on, and also due to the unpredictable outcomes of the conflicts that are taking place that could lead to instability in the value chain and the energy markets. All such risks are therefore envisaged going forward. As for the region, demand coming from China will be very important. There are some risks as to the commercial relationship with China. Brazil, Chile, and Peru export commodities to China, and they might be affected by lower exports in case China sees external demand being affected. Also, copper, 60% of exports from Chile go to China. Lower demand, therefore, could also affect copper prices in Chile and therefore affect export revenues going to the country. There are also some exposures due to shifts in remittances, because now border controls are more stringent. There are also tighter immigration policies. Remittances are particularly important for some countries in the region, particularly in Central America, that has allowed for more sustained growth in the region. External accounts are also more stable, and fiscal deficits have been moderate as a result of these remittances, leading to improved macroeconomic conditions for those countries. We also observe high exposure in Honduras and Salvador, where remittances account for 20% of GDP. In Mexico, they have grown all the way up to 4% over GDP. In Peru, Colombia, and Ecuador, they have also seen some benefits. Remittances can therefore have quite an impact, and immigration restrictions could exacerbate the labor shortage in the United States, pushing inflation up as a result of salaries. This is therefore another impact the markets are pricing in, taking into account the potential inflationary impact in the United States and how they could affect the Fed's rates going forward. All in all, external accounts in Colombia, Peru, and Chile have shown some corrections. These began last year and continued this year. Peru has been able to consolidate its surplus with a current account surplus that this year might reach 1.7% over GDP, showing therefore better exchange terms and conditions and increased export volumes. In Chile, current account performance has also been improved, nearing 2.2%, whereas in the past it was 3%. There was also improvement in terms of the trade balance. In Colombia, even though external developments continue to be a concern, a significant adjustment has taken place with a current account deficit that is 2.1%, according to our estimate, with more imbalances in the trade balance due to lower coal and oil exports, and since the price of such commodities fell. However, this has been offset by the service account, with tourism being a number one performance. Regarding capital flows, as Martin mentioned before, FDI remains significant. They continue to prevail, reporting some increases in Peru as well as in Chile, and a slight moderation in some countries. However, it remains quite high all in all, and there has also been some changes as for residence accounts. In Peru, reserves have been penting up thanks to the surplus current account and a moderate increase in FDI. At the same time, we have observed some significant portfolio inflows that have been used in order to finance fiscal deficit that went up in 2024. In Chile, FDI is expected to remain strong as far as copper, lithium, and renewable energies continue to show very positive prospects due to the good commodity price situation. In Colombia, prices went down, affecting FDI. However, we believe that this will continue to be the main funding source for external balance this year. Regarding portfolio flows, we still observe some sustained fiscal deficits that will lead to some significant funding requirements, making these portfolio flows necessary. But there is also some uncertainty as for domestic policies. In the particular case of Colombia, the risk premium is quite high, and that could limit portfolio flows to the country in the coming years. Okay, let us change slide. In the current monetary policy context, we might expect some interest rate cuts. However, interest rates are expected to be slashed more slowly compared to 2024. The Fed paused its interest rate cuts. We continue to see some inflationary pressures with an increase with some fiscal pressures and some peso depreciation. We believe that this will reach 8%, which means that the monetary policy stance is still quite restrictive, and as a result, growth perspectives for the country will be affected. In Peru, inflation remains moderate. Last year, it stood at 2%, and as a result, the central bank was able to reduce interest rates to a more neutral level. However, they do not seem willing to continue cutting the interest rate because there are still some volatile external conditions affecting the country. As for Chile, the central bank also implemented a halt, and we believe that interest rate cuts going forward will remain moderate. There are some inflationary pressures resulting from costs and the exchange rate in the country. So if the domestic currency continues to depreciate more persistently than expected, that may make it more difficult to reach the 3% inflation rate target. So this is our outlook for the region. We believe that interest rate cuts will take place more gradually compared to the closing of 2024. In closing, fiscal adjustment was slower than estimated for all three countries. In Peru, fiscal accounts reported a fiscal deficit that was slightly above the target due to some economic shocks that impaired growth, and also due to some legislative measures that had an impact on expenditure as well as on people's salaries. However, they continue to provide a sound fiscal rule that may signal some ongoing fiscal consolidation. In Chile, revenue went down, and that made it more difficult to accommodate some expenditure policies that were quite ambitious. At the end of 2024, major efforts were made in order to cut expenditure and in order to increase copper exports. As a result, fiscal deficit that stood at 3.7% was reduced consistently. We believe that this year is going to be close to 3%, which is still considerably above the 1.9% target. Going forward, we believe that reinforcing measures will be key in order to promote investments in copper, renewable energies, and lithium in order to improve fiscal income and in order to stabilize fiscal accounts in Chile. With regard to Colombia, some significant impairments occurred over the past year in the country's fiscal accounts, with estimated revenue being much higher than what they expected. Primary expenditure remained high, and despite budgetary slashes announced by the government, there are still some challenges in order to attain the fiscal deficit target set for this year and next year. This year, this deficit could reach 6 or 6.5% if we take into account income deviations and expenditure deviations. This has led to significant pressures on the risk perception for Colombia that has remained significantly high, making funding conditions for the country more difficult for 2025. If compared with other countries that are also facing challenging situations but are reporting some improvements, as it is the case of Chile and Peru, that are perceived to be less risky countries. This will also affect capital flows. I'm talking about the political scenario and coming elections in several countries across the region. In Peru, Colombia, and Chile, there will be elections in the coming years, as you can see on the following slide. In this sense, long-term growth has been significant. In Chile, this is again in the spotlight as a result of the election debate. There is a potential drop that was 3.5% prior to the pandemic and now near 2%. Therefore, there is some ongoing debate in the country and some measures are being taken in order to reduce bureaucratic procedures and enhance productivity. In Chile, a pension reform has been approved. And even though it was not approved as initially expected and some amendments did not actually come through over the past year, this all the same shows that agreements can be reached in Chile. This is also a good example of how presidential elections will play a very important role, as well as parliamentary elections, because they could provide the current administration the majority required in order to promote potential growth. That is not the most important short-term factor, yet it is important in the long run. And this is something that investors have factored in because the region is not growing and because social tensions have remained high, affecting the investors' interest in the region negatively. Therefore, these reforms may point to a long-term growth situation, rendering the region more alluring for foreign investors. Thank you very much. Thank you, Maria Paula and Martin, for sharing this analysis with us. Thank you, Martin Tobal, as well. It is quite clear that this year the region will face a very challenging context due to a complex global landscape affected by lower residence capital flows to emerging economies. Against this backdrop, there is a positive view as for the opportunities that this may provide to the region, even though capital flows may be lower. FDI, nonetheless, will remain key. There will be, there are some nuances across the countries in the region because this is a heterogeneous region. In this context, the region will have to adapt itself to potential global trade conditions, and fiscal and monetary sustainability will be key in addition to the implementation of some pragmatic additional measures to attract investments in a context characterized by geopolitical tensions. We are running out of time, so I would like to open the floor for questions and comments. I would ask you to kindly provide short answers. Martin Castellano, let me start with you. In global financial markets, the result of recent elections in the United States have shown lower volatility compared to 2016. Do you believe that markets are less nervous right now when it comes to reacting to disruptive measures and announcements compared to the past? And can this have an impact on the region's economies? And along these lines, do you think that the geopolitical criterion is more important than the economic criteria based on economic fundamentals when it comes to global investors' decision making? And also in connection to Martin Tobal's presentation, I would like to hear your opinion, Martin. Well, I don't think that now people are less nervous than in 2016. However, perhaps there is not so much uncertainty because we already have some background information. And I believe that the prior experience may be useful in order to understand the current relationship with Mexico. So it might be reasonable to assume especially if we look at Colombia, Mexico, and Panama, which have been the first countries in the region being affected, we might expect a distinction among countries in the region. There are some economies with whom we have closer commercial relationships, or there are some countries which are more important for the United States, such as Mexico. After strong security collaboration and immigration collaboration, and in case some retaliation occurs, and we can point to the 2016, 2018, and 19 experience with Trump, I believe that this background information might be important in order to assess what we can expect going forward. In the case of other economies with a relative weight in the relationship with the United States, but that have a greater reliance on the U.S., perhaps levying tariffs on those countries could have more significant adverse effects. So in order to manage this uncertainty, as you said, Carlos, in the region there are economic, monetary, and fiscal policy frameworks that are well consolidated and credible enough, with inflation rate targets released by autonomous central banks and flexible exchange rates. All these, therefore, is a buffer. Volatility is ingrained in the rules of the game. Therefore, those countries that are perhaps less flexible or more pegged to the US dollars might have more difficulties. Keeping trade benefits and remittances and investment levels will require a more flexible and pragmatic approach in political and economic terms, and this will entail a challenge for many governments, especially for center-left administrations. Increasing trade and intra-regional Commerce will be key, as well as promoting liquidity in domestic markets, harmonizing regulatory frameworks. I believe that all these measures will be assessed by investors when it comes to making investing decisions. As Martin pointed out, we should not compete over private investment in the current global geopolitical context. Now let me turn to Martin Tobal. Martin, remittances have been a source of revenue and external funding that was very important, and most countries in the region have received such revenue. How do you think that the new Trump administration could affect the flow of remittances to the region? And on the other hand, there's another question, interesting question, as to the GFC and the pandemic that led to sudden stops in the region that did not last much. Do you think that this is due to the fact that the United States was highly involved in both crises, leading to a high or top scale response by the Fed? This is also connected to what Martin Castellano mentioned when he referred to the macroeconomic factors in the region. But I'm talking about the duration of sudden stops as a result of the Fed's reaction. Thank you very much, Carlos. I believe that it's going to be difficult to answer briefly. That will be the most difficult part of the question, but I will do my best. The first question concerning remittances, I believe that there are three mechanisms. One mechanism that is concerned with transfers, and they are rich. There might be some downward pressure on remittances due to the new immigration policy of the Trump administration, leading to fewer migrant workers in the United States and therefore lower remittances. Second, how many remittances are sent through each transfer. I believe that this has to do with the labor market performance in the United States, and particularly in those labor sectors where most migrant workers work, for example, the service sector. But there's a third long-term channel that is often overlooked and nobody speaks about this mechanism. I'm talking about the impact of the new administration's policy on the technology sector. Even though the impact or the number of remittances that are sent through digital platforms remains low, or through electronic transfers, Mr. Giraldo is saying that perhaps Martin is having some technical issues. Martin, you're back. So the technology sector is deregulated, and if there is a technological innovation push, eventually that can accelerate remittances rather than the opposite. Now, what about the impact that this could have on the economy and the financial system? In a nutshell, I believe that there is heterogeneity across countries, and in some economies, remittances account for 15% of their GDP. That is the case of Honduras or El Salvador. In Mexico, remittances are high, but its weight is about 3 or 4% over GDP only. In large countries, I believe that the direct impact will not be so significant in aggregate terms or in macroeconomic terms. I believe that it's going to be more important for private consumption. We should pay attention to the impact that this could have for some families or many families, low-income families specifically. In Mexico, remittances are often received by formal and informal workers from different social and education levels, but remittances are important for low-income people. So I think that this will have some economic consequences, and we should really pay close attention to those people who are most in need for these remittances. Sometimes these people do not participate actively in the financial system. In Mexico, remittances reduce, for example, the market share of local markets. And that has an impact on the profitability of banks, but it's not a big impact in quantitative terms. For the financial system, therefore, it's quite clear. Rather than being a systemic risk, I believe that we should pay attention to the impact that this could have on certain people that, despite the fact that are quite disadvantaged, have access to some credit segments. Now, turning to the second question, which is also quite complex, and somehow it's concealing a complex matter. So these high-scale measures taken by the Fed and how this has affected global inflation, I believe that you want me to talk about that, and therefore I will try to first answer the question and then I will turn back to this point. I don't know whether I will be replicating Larry Summers or Paul Krugman, actually. As for the first question, in the short term, there's no doubt whatsoever, and there's a lot of discussion about the effects in the medium term. Increased liquidity provision in times of stress may lead to reducing risk aversion, and this has a positive effect on EMEs, but these outcomes are not linear. When you have a sudden increase of risk aversion, that normally punishes those countries that perceive themselves as being risky countries. So the Fed's policy has helped. We don't know how much. It's difficult to quantify, but there's no doubt whatsoever that this was not a substitute for well, this has not led to EMEs not being perceived as risky economies. Actually, this approach does not replace the other. Now, turning to the other hot point, perhaps I should actually leave you with more questions rather than providing you with answers. This large-scale response by the Fed delivers some positive short-term outcomes. The question is, what impact could these measures have in the long term as for monetary policy in emerging economies? Thank you very much, Carlos, for your question. Thank you very much, Martin, for such a thorough answer. Now let me turn to Maria Paula. Maria Paula, during your presentation, you referred to different factors that are pushing up volatility. Volatility might increase even further in the EMEs regarding capital flows. And I have a specific question about this. International investors seem to have an appetite for Latin America that is greater than the appetite they experience for other emerging economies. Thank you, Carlos. In fact, we have observed some divergences in the position that different countries have and their outlook on debt portfolios. And we have also pointed that out in our recent capital flows report. If we take a look at local performance, we should highlight the role played by India. India has the capacity to attract major investments due to some economic reforms and the country's inclusion on the JP Morgan index. This has improved their market positioning, and now India appears to be an interesting country in the global picture, despite the fact that some capital outflows occurred at the end of last year. Indonesia and South Korea should also be highlighted. These countries have also been going through some global supply chain diversification, and they are showing some significant capacity to attract capital flows. All these countries, Asian countries, show a great deal of potential to increase their share in the manufacturing sector, in the electronic sector, or in the supply chain at large. So they may appear to be alluring for investors in the current volatile economic and financial context. There are therefore some divergences. If we now turn to Latin America, we have also spotted some significant opportunities stemming from geopolitical pressures and some international trade realignments. In Latin America, some countries are benefiting from high commodity prices. We have already mentioned the volatility risks inherent to commodity prices. However, for the time being, we observe that metal prices remain high. China has remained resilient. We have observed some metal supply and demand issues. And all this leads to some significant opportunities for some Latin American countries that export metals and commodities. Thank you, Paola. We have one final round of questions. I'm going to summarize the questions because we're running out of time. Martin Tobal, this question is for you. The new policies of the U.S. administration could affect front-shoring and near-shoring trends. Is that right? Martin, please, you have the floor. Well, we don't know the extent to which this might occur, but it will depend on several factors. Tariffs levied on imports might be temporary or permanent, but we have to see how investors perceive them. This is particularly relevant for those sectors that are more fragmentation prone. In some cases, it's not easy to relocate some activities. For example, in the automotive sector, you require plenty of coordination between vendors. You need long-term agreements. So whether import tariffs are temporary or permanent might make the difference. But we believe that the impact of these measures for some companies will not take place right away. We have to see what happens with tariffs and how they affect the different sectors across countries. There is some compelling evidence if we take into account the first Trump administration. There are many authors such as Pablo Harsatz. Chikari is co-author of a study of mine. All these studies contain evidence showing that the first Trump administration was characterized by some levies or tariffs on imports, but this eventually favored Vietnam and Mexico, even though it was to the detriment of China. So it depends on how tariffs are eventually set up between sectors and between countries. Perhaps this is kind of a simplistic answer. It is true that this is part of the current context. Some of these measures might be risky, but from a public policy perspective, it may be erroneous to believe that this might be the only factor that counts. When making long-term investments, companies take into account many other aspects, such as the institutional framework, especially when it comes to certain investments. For example, human capital supply, the availability of specialists, the availability of the right infrastructure or telecommunication networks. All this is important. This will vary from country to country, from sector to sector. But in creating public policies or in designing public policies, we believe that public policy makers should be aware of what's within their control, because what is still within their control remains relevant. Thank you very much. Now let me turn to Maria Paola. Maria Paola, you talked about how the countries in the region could harness or tap into the current opportunities provided by the global geopolitical context. Can you elaborate further on that? You're muted, Maria Paola. When we began analyzing policy changes in the United States, we observed that the region could benefit from higher commodity prices, as well as from value supply chain changes. We observed that the tariff policy was going to be particularly focused on China, because the tensions between China and the United States are long-lasting, and this could eventually affect Mexico in nearshoring terms. So far, we observe that there is plenty of room in order to improve logistic infrastructure, in order to enhance the commercial reorientation of these countries. Other countries have benefited themselves and have some positive prospects resulting from increased integration, or by playing a stronger role in the manufacturing sector or in the pharmaceutical sector. Costa Rica, Panama, and the Dominican Republic may have an opportunity in this respect. In those countries, some significant increases have occurred in terms of FDI. So we believe that these are some of the opportunities that remain unaltered despite of the current uncertain external adverse context. And against this backdrop, I would like to highlight two aspects. Growth on the one hand, growth is still at a standstill in the region, and that should be a priority going forward. That is to say, increasing productivity in the region is key. And also fiscal policy. That's another relevant issue. It's necessary to speed up the consolidation process that in some countries has been slower than it should have been, and that might be affecting local risk perception and might also be affecting monetary policy. Even though the fact that there are strong macroeconomic frameworks with clear fiscal anchors and rules, and central banks that have provided effective answers to inflationary pressures, all that provide significant support in economic fundamental terms, and this should all contribute to step up the region's resilience. Thank you very much, Maria Paola. Now, in closing, I would like to ask Martín Castellano the following. During the first round, you drew a comparison between today's presentation and the prior presentation. Do you believe that there might be increased external liquidity risks now compared to August last year when we held another webinar? In the past, there were some sudden changes in external conditions and increased volatility. The region's exposure remains high to all such developments, especially rate spreads, among others. Nonetheless, all such events were quite infrequent and they were quite short. They did not last much. Therefore, this shows that despite high exposure, external vulnerability in the region is lower compared to the past. And this is because many countries have been able to build buffers or now have stronger monetary policies in place or have reinforced their public finances despite some imbalances, but which all the same are now based on certain rules, also banking regulations. All such pillars have therefore contributed to macroeconomic stability in the past. Now, going forward, and in a more adverse geopolitical and challenging context, perhaps this will not be sufficient in order to maintain macroeconomic stability. And therefore, the geopolitical variable makes it mandatory to be more flexible and pragmatic in designing policies. This will push pressure up among policymakers in order to allure or attract foreign investment. And I believe that it's going to become increasingly more urgent to introduce some improvements. Those governments that move faster in this direction and in sending positive signs, I believe that they will benefit the most. Thank you very much. Unfortunately, time is up. We had to shorten many questions, but this certainly encourages us to keep on having this dialogue in the future. We would like to thank Maria Paola Figueroa, Martin Castellano, and Martin Tobal for their excellent presentations and for answering our questions. We have been able to talk about the short-term and the long-term outlook for capital flows, and we have also been able to talk about domestic risks and external risks affecting the region in the global context. We have analyzed how capital flows are faced by many structural and circumstantial challenges with a mix that is difficult to sort out in the current backdrop. And as Martin mentioned, stability will be a key aspect for all countries in the region, and this goes hand in hand with the appropriate monetary and fiscal policies, as it has been the case so far, but also other policies that as a whole should take into account the macroeconomic aspects. We also need a sound institutional framework like the ones that have been built over the past decade. Thank you very much for your attendance, and we look forward to another discussion on these topics in the near future. Have a nice day.